Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about Jerome Powell's remarks at the Fed meeting and where mortgage rates are headed. First, I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here, and we're going to first start by saying the 10-year yield held the line, right? Like we talked about in the last podcast, even though it closed above 440, if there's no selling after that, there's no break of the line. And what bond traders do, they're like, oh, we got to go long. And I think the low of today, this is Friday morning, was 4.27% on the 10-year yield. So key level held again. So for now, a positive. And I let me give you some personal anecdotes. Not a lot, but some of the bond people that I know that were saying, oh, 10-year yield could go up 5%. And, they've already gone long bonds right now. So just remember, there's going to be a lot of noise from Wall Street types. A lot of times they talk their books. So, but, if key levels don't break, they tend to reverse quickly, as we've seen, down on the Hodor line as well.
Okay, so do a recap. Since election day on Tuesday, where has the 10-year yield / mortgage rates, right? Because our audience, I know you track 10-year yield. They need to know where mortgage rates been, where are they going?
Okay, so the 10-year yield intraday night trading got, I think, like 4.47, closed at 4.44, and then quickly reversed. We had a really good mortgage pricing day on Thursday, so it was under 7%. And most likely today we'll have a little bit better pricing. So a good in a sense that we show the benefits of having better spreads this year. That, if we had the same mortgage spreads of last year, mortgage rates are over 7.60%. So positive. And we can see it in the housing data, a little bit more firmer bottom this time with demand. And all we need is mortgage rates heading towards 6%. Right. And we saw this late 2022, early 2023. We saw this in 2024, the mid part. We still see it. We'll find out if the pending contracts data still looks good for when this comes out on Monday. But I can't stress how much a difference it makes that the spreads are normal, or not normal, but much better year over year. We still have a long way to go to get anywhere near normal again. But for now, a positive for the mortgage market, that even in a very volatile 10-year yield, spreads did get worse, but nowhere near to what we saw last year.
So last time we talked was on Wednesday morning. So it was before the Fed cut rates by 25 basis points, totally expected. But what was not expected was some of the fireworks that happened in the press conference. So let's talk about what the Fed did on Wednesday.
So the best part of the whole thing was when they asked Powell if he would leave. And I just thought of Leo DiCaprio in Wolf of Wall Street. I'm not bleeping leaving. No, and he just said, no. President Trump can't fire him. He could stay his entire time. So what occurred was he basically said, I'll allow Powell to work throughout his whole term. So most likely Powell in 2026 is gone. But I found a lot of good nuggets with, I thought Jerome Powell did really good with the Q&A questions. And some people that have listened to us all year, a lot of things that he said are talking points throughout the podcast for the last 2 years. So I thought number one is when one of the journalists said, hey, listen, why are you cutting rates with core PCE at 2.7%? And he's like, oh, we don't look just at 12 months, 3, 6, 12 months. That goes all the way back to 2022, that when Jerome Powell said we would like the Fed's funds rate to be mirroring 3, 6, 12 months of PCE. This means to me, they have a long way to go to get to neutral. How fast they go there depends on the labor market, but they are consistently heading that way. So we're going to have multiple rate cuts. The speed varies on how the economy does, but that's getting yourself down to neutral. That'll be good for the spreads, right? There'll be less volatility. Also, I don't want watch business news. I think the only time I ever watch business news is after I get it done with interview with CNBC. I'll turn the TV on and look at myself because there's a lag for like 10 seconds. But apparently Steve Mnuchin, who used to be the President Trump's Treasury Secretary, said, we would like to have a cap on the 10-year at 4.5%. They don't want that 10-year yield going toward 5%. Jerome Powell, in his language at the meeting, kind of hinted that, well, bond yields, we've noticed that bond yields have gone up and mortgage rates have gone up, but not back to where we saw in end of 2023. That's a positive. That means, okay, they're mindful of that. So now we have the Fed, we have the incoming White House, and everybody's kind of on the same page. And also in this regard, he finally said housing's weak. We've kind of like ripped on the Fed when the Fed said, oh, the housing market is recovering. Or there's signs of life. It's the third calendar year of the lowest home sales ever. Housing starts at recession levels. Permits are at recession level. We're not building homes. We're not buying a lot of homes. So listen, it's not a strong market or recovery market. So Nick Tamaris, who is the Wall Street Journal's economic reporter, who's basically the outlet of the Fed, on Friday morning, he discussed, because he asked Powell about higher mortgage rates. Is it possible to have a soft landing? I don't like the soft landing term anymore. Is it possible to have an expansion still with mortgage rates elevated? Because job growth is slowing, right? Growth rate is slowing down. It's not breaking, but slowing down right to my forecast. So it looks normal to me. But if mortgage rates kept on going higher, there's your residential construction workers losing their jobs. And if business investment is not, manufacturing jobs are lost. There's your labor trigger to every recession we've had. So I looked at that as a positive early nugget that the Fed has acknowledged, well, the 10-year yield did go up, but not back to 5%. That got their attention. The fact that Steve Mnuchin they're already throwing numbers out. They don't want the 10-year yield above 4.5%. Good. It means there were no 8% mortgage rates. And the fact that now housing is in play, that, listen, if we want to keep this expansion going, we need the housing market to grow sales, right? Grow new home sales, grow permits. Those housing permits don't look good. Those housing starts don't look, if you really want to build homes, because what's the best way to deal with inflation, Sarah?
More supply.
More supply. Yes. Supply is the best way. Now, there are times where you remember team higher rates here. We were in a really bad spot. We were in an extreme shortage of available homes for the existing home sales, but you have to be able to get housing starts and permits going. So I was very happy with what I saw Friday morning and Thursday, that this is now, and what we've talked about, we want the Fed to be dual mandate, which they're doing now. We want people to recognize, okay, we got to keep the housing market somewhat intact. We can't have rates go higher and have new home sales. So these are good things. And then the 10-year yield held its line. So considering how crazy the week was, that's as good as you can get with all the volatility.
That is good. I think it's especially good that, Steve Mnuchin was talking about, we don't want him to go back to 5%. That is the level at which we get 8% mortgage rates, which was the big fear earlier in the week after the election. We had that big spike. It's like, what's going to stop mortgage rates from going higher?
So I encourage everyone to listen to the last podcast if you want to talk about policy and mortgage rates and going up. Again, what conservative Wall Street, let's just be honest. Old men on Wall Street are just cranks. They've always been afraid of the federal debt. They've been wrong all the time. These people are net long. You just ask them, are you net long, sir? Yes. So basically your fear is useless, right? So just ask any podcast stock trader if they're net long, and they have to be, right? Or unless these people are just terrible, on economic calls and corporate earning calls. But in this case, the more important people in this whole economic play that we're watching are starting to be a little bit more mindful of housing. And it makes sense, right? I always show those charts all the time. We, traditionally speaking, when single family permits and multifamily permits fall, starts in a recession, Home Depot warned, Lowe's warned, right? Policy is too restrictive. Every time I show those charts going back to the 1960s, that is a labor trigger recession. It hasn't happened yet because the backlog of homes, right? And we're working through those homes. And now it's like, okay, we're done. Oh, wait, We're not growing permits anymore, are we? No. So there is your front line of jobless claims rising, right? And what is it? Jobless claims rise. That's recessionary. Then rates fall, and it's a little bit too late. So you want to get ahead of the curve. You don't want to wait till the labor market breaks and they go, okay, now we want to do it. You want to be clever, right? And then learn from history, learn from economic cycle work, and get ahead of it. Because if single family permits were rising and 5-unit permits were rising and starts were rising and new homes, that's a whole different conversation. That's not the case. And we see trouble in the housing data when rates are 6.75 to 7.5%. The big builders are doing whatever they can to sell homes, but considering the inventory growth in Texas and Florida, other parts, they're not going to be, building a lot of housing in that area. So equilibrium, right? But it was good to see that that's actually now kind of in the focus now at this stage of the cycle.
I appreciate that so much. I think that it's great to give insight into like, hey, we knew that the last 2 weeks were going to be super volatile, up ahead of the election, up ahead of the Fed rate cut. What do you see going forward in the next couple of weeks that could also be destabilizing? Anything out there that you're like, let's watch out for this?
Okay, so always labor data runs everything. So the labor data gets weaker. We might have a rebound in some jobs numbers just because of the strike and the hurricanes are over. However, we could see a lot of volatility on political economic theory is not my thing, but when somebody says something, the bond market might overreact short term, either up or down. So until we get certain people in place or a little bit calm, there's going to be probably statements made over the next 2 or 3 months that might shake up the bond market here or there in a very short term. But again, long term, the economic data runs everything, right? And that's the key. And I'm just encouraged that the early glimpses that we have seen is that housing is somewhat in their mind. And for Powell, I thought that was one of his best questions and answers, trying to talk people down that they are looking at this in a very long-term fashion. They're not going to be very reactive for headline news or anything, but they are restrictive. Their job, they want to get down to neutral policy. Neutral policy is not accommodative. We have not ever discussed an accommodative policy yet, right? That's a whole different ballgame. If jobless claims start to rise, guess what happens? The bond market does the early work for the Fed. That is a benefit for housing. But we're not there yet. Jobless claims have been falling the last few weeks. So again, economic data runs the show. You can have a lot of pony shows out there that's short term, but I am just happy that 10-year yield held that line. Crayon Economics dropped from 5%. By the way, some of you are using the wrong 10-year yield charts. I've seen it on your Instagrams. You're using a shorter term and you're thinking it's breaking. Just go back to 5%. Black line. It held for now. For now, it's held. I think the counter to something for rates to go higher is that economic growth really takes off, wage growth takes off, the bond market is, panicking, you see more selling, something like that could occur. But for now, for this week, we got through it.
I am so glad we got through it. So one of the stories that our newsroom is looking at is are prices going to go up materially in the new year after Trump is elected? And even if they're not, are people right now buying, specifically building materials, right? Are we going to see that impact any sort of home building costs? And because we see that a lot on social, people claiming that. You and I talked last time about how you're like, you didn't see Trump necessarily doing some of those tariffs right away, but we're kind of looking at like, are people reacting? Even if that's the case, are they reacting and changing some of those things right now?
So the existing home sales market pricing does not work off of what builders' costs are. So the supply and demand equilibrium is more important. So if you're ever talking about existing home prices, Sarah Wheeler, what's our Fight Club rules?
We don't confuse the existing home sales and the new home sales.
Yeah, we don't talk about Fight Club, and we never, ever, under any circumstances, put the new home sales market and the existing home sales market together. Just like that's that. There's a constant theme that home prices always rise if inflation is rising because the cost to build goes up and builders can't, they're not going to be building homes or, selling homes below cost. So, but the existing home sales market is a supply and demand equilibrium, right? And here we are with the second back-to-back years of home sales being around 4 million, and home prices are actually firming up. I'm hoping that we get a little bit of cool down with the tracker this week. But if that's not the case, then what's occurred is that the mortgage rates getting down towards 6% just firmed up the demand, and demand is so low, it doesn't take much to move the needle. And we've had constant decades where, like I try to show this, in the early 80s, in the 90s, in 2000, where you have rising inventory and rising sales, if that's the case. But for now, just take it out of your head. Whatever the new home sales sector is doing, it's not going to be the same for the existing home sales market. Existing home sales market, that's majority of all the action. All the inventory growth that we see in the country really comes from that. Why? Because a builder builds a house, they have a person in contract. When that contract is, the person moves in. It's not a lot of unsold homes that sits there. I think it's we're not even over 120,000 on that. So pricing, rates, credit stress, and again, the history of home prices. This is why I like to show that chart. Somebody came up to me and said, "Hey, listen, well, if rates go down, home prices are going to go up." Dude, homie, since 1942, home prices have gone up, right? You don't sit there and go, what if rates go down and home prices might go? No, there is a time where, listen, it's part of team higher rates in 2021 and 2022. Yeah. Okay. But inventory is elevated. Home price growth has slowed down a lot, right? And if rates fall, you can't sit there and go, wow, that can't happen because, housing starts are at recession lows, permits are at recession lows, third year of the lowest home sales ever. You can't sit there for 5 decades and go, we can't have rates go down because home prices. No, you're in the wrong country. You're thinking that's going to be your model for the next 10 to 20 years. So work off of our tracker, guys. There's nobody else on planet Earth that does it better than us. Just follow the tracker data and we'll discuss the supply and demand equilibrium, because what you've all read for the last 4 to 13 years has been trash. By the way, I want to tell you something. You know what's going to be fun for me, Sarah? Is that this kind of reminds me of like 2016 and 2017. Most of the anti-central bank people are conservatives. I doubt there's a single liberal in that group. But when Trump won, like half of them split off. And they don't talk bad about the economy anymore. But the true believers are going to be like crazy bearish all the time. So it's going to be fun for me to like pick out who's the true believer and who's just, a fair weather fan out there. So I'm excited. I'm excited about, 2025.
I know you are. So I'm at NAR next, and it's been a really good conference. I will say this. Listen, kudos to our real estate friends, everyone out there and I've had lots of people come up and say they listen every day. Thank you for being listeners. It's hard to find a quiet place in a real estate convention. Real estate folks are on the phone. They're selling 24/7. They're kind of chatty people. They're a little bit loud. Like, this is what makes them good at their job. But so it's hilarious trying to find a quiet corner in this entire conference center. But
you should have left the conference center then.
This is where I'm at. But anyway, I do think it's really interesting. There's been a lot of optimism here. At the same time, a lot of just reality of like, we're in a tough market. The people who are left, the people who are doing professional, that they can do a good job, but like there's some real headwinds, right? So I think that's interesting. So when you think about looking at the tracker this weekend, thinking everything we've said, what are you looking for now between the end of the year? What are you going to be watching on the tracker?
So for us, the reason why we think the tracker is so important is that what we're seeing in our data line, the NAR, isn't going to show for months. What we see in pricing, the Case-Shiller index, isn't going to show for months. We have an unfair advantage at looking at current and forward-looking data. I want to see, is the pending sale still going to firm up versus 2022, 2023? Is pricing still going to stay firm? I mean, that's the thing. I mean, like my forecast is at risk of not happening because pricing has stayed firm over the last. And then you see, when you're an analyst, when you're an honest, real person, if the data changes on you, you have to go with it. You can't do what the housing crash people do for 13 years, double, triple, quadruple. What is it like? What do you say after 13 times? I don't even know the word for that. You don't just do that because of, you just want attention. So to me, it's, our pending home sales still staying firm with higher rates. And it's pricing should, it's a seasonal soft period. Rates are up again. Pricing should cool down toward the seasonal decline, and then we pick it up in spring. So that's the interesting aspect, because from now until the end of the year, we're getting into that middle of November. The middle of November in 2022 and 2023, rates started to go lower. Forward-looking housing data picked up. It gave us 500,000 home sales in both years. In 2023, in one print. In 2022 or 2024, we had two back-to-back prints. So I'm keeping an eye on that, because if we had a firming up demand already, and then all of a sudden rates fall, you're going to get a kick in home sales that not a lot of people are going to see. But we now, tracking this with such low levels of sales, we have something to work off of. This is why it's very exciting. Like, if you're a total nerd, you're just really excited here because of the recent data. And again, if you don't read the tracker, you have no idea what I'm talking about, right? Because you're all working off of old stale data. And so that's what I'm looking at, because we've seen something like this the last 2 years. Now, did we already get the lower rate move, or, our rate's not going to get down toward, 6.25 to test this for the third year? Well, again, the economic data works off that. But boy, the tracker the last 6 to 7 weeks have been very noticeable. We've talked about it. Mike Simonson talked about it. We're going to do a podcast that's going to come out soon. Mike Simonson and myself, that's going to be nerdy beyond belief, but you'll get a good explanation of what two different analysts look at the same kind of data.
I love that. That's the Top of Mind podcast, which Mike Simonson's the host of. He's going to have you on. That is going to be a fun conversation. Two nerds, right? And we're coming up on the second anniversary next month. Next month of the tracker. I remember it well, because I think it was the day after Christmas. And you're like, I wrote this tracker. We're launching it. We were trying to wait to the new year, and you're like, no, I have to write it right now. I was like, okay.
It's November 8th, right? It was November 9th, 2 years ago, that the housing dynamic shifted, right? And that was the thing. And remember how many videos, we have to go back and look at those videos that we created, where the forward-looking data is getting better, people. And by the time 6 months from now, you're going to go, what the hell happened? Why didn't home prices crash? We were told 10, 15, 20%. People are just making up numbers. It's hilarious. By the way, college professors, when they forecast something, they go 10 to 20. They never go in between or anything out there. The forward-looking data changed after November 9th, 2022, and that structurally changed the entire housing dynamics, because 2022 had the fastest crash in home sales. So it was a theory of mine that I have to prove it to you, that if homes, and when we talked about this, home sales just recently broke under 5 million. So to say that we're going to go to 4 million and stop, and for that to happen in a very short amount of time, that's how crazy that last 6 months of 2020 was. But it stopped crashing. And then the entire housing dynamics shifted. And it's 2 years now. Now that you've all seen it, you've all witnessed this. This was what I was talking about. The structural dynamics of housing changed after November 9th, 2020, from the fastest crash, where we had authentic price declines, in 2022. And I think one of the things that a lot of people forget is that home prices were running at 17 to 19% the early part of 2022. So you're looking for that price decline from that very hot period time of the year, and then home sales stopped crashing, and now we're here. And then you go back to the history of housing economics since 1942, you could understand this stuff a little bit. And that's why I wanted the tracker. And you're like, no, you can't do it. So I'm doing it. You're going to have to arrest me. I'm going to do it before the year. Imagine me. I'm like November 9th. I'm like, I need this tracker to get on. It's happening. It's happening. I need to have people see it. And,
I wanted you to do it. It's just that we wanted to brand it and launch it. And you're like,
no, I don't think legally we could have done it. I think that's the thing. So, but again, it's 2 years now, right? There was a COVID-19 recovery model that I wrote on April 7th, 2020, retired on December, but I always think of November 9th, 2022, even being more prolific than that, because everybody was into the one trade. And I don't care about a forecast. I care about a model. And if the model turns, that's what the whole point was. The whole point of this tracker, if the forward-looking demand data turns, you have to go with it. You don't want to be old and slow and wait 6 months and go, what happened? I didn't know. There is way too much data out there to be an old tortoise now.
Absolutely. Before we go, I just want to remind people we are going to have a Housing Economic Summit February 26th of 2025. You are going to be the keynote. Mike Simonson's going to be speaking. We have Selma Hepp already signed up. We've got a ton of amazing economic speakers all in the same place, all on the same day in Dallas. So people need to mark their calendars for that.
Oh, God. Could you imagine that? I don't know how many conferences you have where you have all those housing economists into one day. That's going to be a lot of fun. And talk about a nerd fest. And you're going to have a lot of different takes on housing. And it's going to be toward the end of February, right into the spring season. So talk about timing is perfect for something like that.
Love it. And we're going to go over forecasts. We have people broken out by like what their specialty is so that you're getting the full picture. So it's going to be amazing. Logan, thanks for being on today. And we will see you soon.
I'll see you soon. And I just want to let you know, Christian McCaffrey's back on my fantasy football team.
Oh, so great.
I got my best player back and I'm in first place. You're all in trouble in the league.
Man, we're just hanging on at this point. Okay. Thanks, Logan. Bye.